Investment market performance in 2018 has been a little bit more mixed than it has in recent years. If I can take you back to the GFC, we've just cycled through in March the 9-year anniversary from the market lows in the GFC. And what's happened since that time is we've had actually exceptional returns in equity markets of almost 300%, so almost 20% per annum compound returns over that period of time. So very, very strong results, really driven by the fact that back post the GFC, the world was full of fear and shares were cheap. We've seen a gradual economic recovery and we've seen central banks stimulate their economies. So what we've seen in the beginning of 2018, and something we've been talking about for a period of time, is a bit more volatility coming into markets. And really this is being driven by three factors. One is that shares are a lot more expensive now than they were 9 years ago. The second is that interest rates are starting to move up. And the third, and the last thing that's really driving a bit of volatility in markets, is central bank liquidity withdrawal. Well, as I mentioned earlier, we're seeing more volatility in markets and we're seeing mixed performance. In fact, across global share markets, Australian shares and listed property trusts, we're seeing quite negative returns into the first quarter of the year, between -1.5% and -6%. We're seeing more defensive asset classes like bonds pretty flat, and gold a slight positive, but we're seeing things like the Australian dollar and high yield bonds actually underperforming in this environment. So where the real change to this is, we've been on a one-way track of very, very significantly low volatility, rising market environment for some period of time. We're now seeing heightened levels of volatility and lower returns for asset classes, certainly year to date. As risk assets such as equity markets have moved higher in valuation over recent years, we've been actively taking risk off the table. And that's being represented in the portfolio in a number of ways. The first is we've been building our cash holdings within the portfolio. It's a really key element to allow us to take advantage of volatility and when things become cheaper. The second is we've been increasing our exposure to private markets within the portfolio, which is an unlisted property. And the third is we have a strong allocation to the alternatives asset class in the portfolio, which we've maintained. So this is really an asset class that diversifies us away from the core risks of equity markets and interest rates. And actually we've seen some quite strong returns from some of the long-short managers within that part of the portfolio in this part of the year. You know, names like of Benelong Long Short, the Regal Tasman Fund and Zebedee, located in London. You know, we think that markets have really been putting risk at the back of their mind. Given those factors I spoke about earlier around interest rates, liquidity withdrawal and valuations, we think it's coming more to the forefront of investors. And this is where we think the benefits of a truly diversified portfolio will really play into us being able to achieve our objectives for our investors in a more consistent return manner than if you had just a more of a market-linked portfolio. I think another key point there about future returns and where the portfolio is positioned at the moment is we remain incredibly active around managing exposures within the portfolio. So one of the key reasons that we've built cash is not for the return in cash at the moment. Anybody who's got a term deposit knows it's barely above inflation. It's a place for us to park liquidity when we think, or cash, when we think valuations are getting expensive. We would actually invite a bit of volatility into markets at the moment to allow us to take advantage of buying things tomorrow at a cheaper price than what we can buy them today. The performance of investment markets has been exceptionally strong in recent years, and we think going forward it's unrealistic to expect that the recent strength is going to be repeated. So as an example, global shares appreciated about 20% in 2017. Like, that's a big number. Now, things are more expensive and we think that we're not going to do anywhere near 20% in global shares this year. So fortunately, our approach means we don't rely on one asset class, such as equities, to deliver all of our return, and we're able to diversify our risk and pull on a range of other sources of return in both listed and unlisted markets, which we think are going to be really key in delivering returns this year, as they have been historically for us. So despite the lower return environment that we find ourselves in, we're really confident about achieving our investment